Ever wondered how banks decide to give you a loan or a credit card? It all comes down to something called a credit score. This is a 3-digit number that reflects your creditworthiness, or in simpler terms, how likely you are to repay your debts. In the world of finance, your credit score is like your reputation. It plays a crucial role when you're trying to secure a loan, a mortgage, or even a new credit card. Think of a credit score as a report card for borrowers. Now, you might be asking, what makes up a credit score? Well, let's dive into the 5 main ingredients that stir up this financial soup. Firstly, we have payment history. It's the heavyweight champion, making up about 35% of your score. This keeps track of whether you're punctual with your payments or if you tend to take your sweet time. Next, we have amounts owed, representing around 30%. This isn't just about how much you owe, but how much of your available credit you're using. The less, the better. Length of credit history, making up about 15%, is our third factor. The longer your credit history, the more information lenders have to assess your reliability. Fourthly, new credit, making up roughly 10%. Opening many new accounts in a short time can be a red flag. Lastly, types of credit used, also around 10%. A mix of credit types can show lenders you can handle different kinds of debt. So, every financial decision you make, from paying your bills on time to opening a new credit card, can affect your credit score. Now that we know what a credit score is and what affects it, why does it matter? Your credit score is like your financial report card. Lenders, like banks and credit card companies, look at your credit score to determine your credit worthiness. In other words, they use it to gauge how likely you are to repay your debts. If you have a high credit score, lenders may see you as less risky, which can make it easier for you to secure loans or credit cards. Not only that, but a good credit score can also help you secure loans at lower interest rates, saving you money in the long run. On the flip side, a low credit score can make lenders cautious, potentially leading to higher interest rates or even loan denials. Having a good credit score can make a big difference when it comes to your financial future. So, what can you do if your credit score isn't where you want it to be? Well, there are several strategies to consider. First and foremost, make it a priority to pay all your bills on time. Late payments can significantly impact your credit score. Secondly, try to keep your credit card balances as low as possible. High balances can signal to lenders that you're overextended and less likely to pay back your debts. Another tip is to avoid opening too many new accounts in a short period. Each new account can slightly lower your credit score. Lastly, don't forget to regularly check your credit report for any errors. Correcting these can help improve your score. Remember, improving your credit score is a marathon, not a sprint. It takes time, but with consistent effort, you can raise your score.